Welcome to Age, Pension, Super and Retirement. I am your host Yvonne, and as always, this podcast is information only and not personal advice. In today's episode, we are going to be looking at income estimate for childcare subsidy and family tax benefit. And to unpack this, I would like to welcome back the very knowledgeable Rebecca.
Thanks, Yvonne. This topic's a bit different to what we normally talk about, but there's a lot of people, a lot of parents getting childcare subsidy or family tax benefit. So I think will be a lot of interest in this episode.
I'll be learning along with you for this one. So to begin with, Rebecca, why are we talking about the income estimate now in April?
Yeah, good question, because it's not June, it's not July, this end or start of the financial year, but in April. So April 1st is when Centrelink starts sending tasks out on their computer system, inviting people to make their income estimate for the next financial year. They start it way ahead of time in April. You don't have to do it straight away. It's not an urgent task, but you may see it there. If you log into your account, you may see a task saying, do your income estimate for 26-27 financial year. So that's why we're talking about it now, because people are going to see it in their accounts now and might be thinking, what do I need to do about this?
So if we take a step back, Rebecca, what is an income estimate?
An income estimate is an estimate or a rough idea of what your income is going to be for the upcoming financial year. So people get a bit confused about that. Well, what does this mean? But realistically, what they want is they're wanting a prediction of what your tax return for that year is going to say. So on your tax return, when you lodge your tax return, there's lots of different types of income, lots of different sections of the tax return that you're going to complete or your accountant is going to complete. And it includes, you think about like all of those things on your tax return. There's your work income, there's bank account income like interest and things, investment income. There's like from work, you might get, when you're thinking about work income, you're thinking, well, there's your base salary, there might be overtime, bonuses, all those different components of your work income. There's also any fringe benefits that you get from work. They appear on your tax return too. So some people might have salary packaging to, you might be salary packaging your rent or your mortgage, or you might have a leased car that's partly salary packaged. All of these components are going to be on your tax return. So you need to think about all of them when you're going to do your income estimate. Also things like if you have an investment property that sells in the financial year, that's going to be included on your tax return. If you have a withdrawal from super, maybe under compassionate release, you might have access some super, that's going to appear on your tax return. There's also tax-free benefits that can sometimes appear on your tax return. There's so many different types of income that are going to be on there. There's also deductions that you might claim. So maybe you're making contributions to super that as a tax deduction, that's going to be on your tax return too. Any investment losses are going to be on your tax return. So you get lots and lots of different things that will end up on your tax return that you need to kind of try and predict what's going to be on my tax return. Therefore, I'm going to put these amounts on my income estimate.
That actually sounds tricky, Rebecca. So how accurate does it actually need to be?
It is tricky. There is a lot that goes on a tax return, particularly for people who have sort of more complicated finances. Like for some people, it's pretty simple. I get paid $70,000. That's what's going to be on my tax return. But for other people, it is more complicated. Basically, you want it to be as accurate as you can make it without worrying too much. Now, there are some buffers built into the system. So Centrelink uses these amounts to pay you the right amount of childcare subsidy and family tax benefit. But there are a couple of buffers built into the system. So for childcare subsidy, they will look at your income estimate and let's say your income estimate is $200,000 combined. They'll look at that and go, okay, so for $200,000, this is the rate of childcare subsidy you're eligible for. But just in case, we will withhold 5% of that entitlement to the end of the year, which just gives you a bit of a buffer. So a 5% withholding for childcare subsidy works out to around about $25,000 worth of buffer of extra income. So if you say we think it's going to be 200,000, the 5% withholding sort of means that if you end up at 220, 225, you're probably not going to get a childcare subsidy debt because that 5% buffer kind of covers you. So yeah, you don't need to be too worried about getting it right down to the cent. But I would suggest that you have a think about like what pay rises are expected in my industry. So you can always look at, what am I getting paid this year? Because you kind of know by now about what your income's going to be for this financial year. You can say, well, let's take that amount and add 5% because like that's maybe an expected increase with inflation, with wage increases. But if there's going to be extra things that you know about, you can put them in. You don't have to be too accurate because there is that buffer built in the system. If you're someone who your income is just so unpredictable, you just really can't pin it down, you can make that buffer bigger. You can actually manually adjust the withholding amount. So you could make it 10% or 20%, which just gives you a much bigger buffer in case your income is not what you said it would be. So that's sort of for talking about childcare subsidy. Family tax benefit, again, you want to be as accurate as possible. So particularly with family tax benefit, there is a healthcare card linked to family tax benefit if you are getting the maximum rate. And the maximum rate is going to be payable when your income is under a certain level. So if you overestimate too much, like we generally do tell people, look, overestimate, think about what you're going to get, and then just add a little bit more as a buffer. And that is a good general rule. But if your income is fairly low and you're hoping to get a healthcare card, you sort of want to make your income more accurate rather than overestimated so that you can get the healthcare card. If you think your income's going to be $60,000 or $65,000 and you say, I don't want to get a debt, I better put $80,000 instead, putting $80,000 is going to mean that you miss out on getting a healthcare card. So in that situation, you're probably better off being more accurate. And then for people with low incomes, so I'm talking about under $80,000 as a combined income for the year, those people do have a buffer built in as well. So for people under $80,000, there is a family tax benefit Part A supplement, which is paid at the end of the year when your income is under 80,000. And so that again provides a bit of a buffer for, if you were paid a bit too much during the year, that supplement helps to kind of balance it out a bit so that you are not likely to get a debt. So I guess stepping back one step further is the idea that so both family tax benefit and childcare subsidy are different to other types of Centrelink payments because other Centrelink payments like age pension, job seeker, they are a fortnightly entitlement based on your income that fortnight. But family tax benefit and childcare subsidy are annual entitlements based on your annual income. So for some people, your income might fluctuate fortnight to fortnight. But for family tax benefit and childcare subsidy, they're looking at, okay, what is your whole income over the whole year? And we need to pay you your family tax or childcare subsidy based on what we think your whole year income is going to be. So that's like a positive in some situations and a negative in others. So, you do have to try and predict what your full year income is going to be. And that can be tricky for some people, but it also sort of helps to buffer out things a bit too, because, if you have a period where you're out of work for some time, that's going to lower your full year income and might mean that you get a higher rate of family tax benefit or childcare subsidy.
That is so helpful, Rebecca. And I need to ask, are there some types of income that are not included on the estimate?
Yes, there are. So like we've talked about in other episodes, the Centrelink and the ATO look at income differently. They have different rules for what is income and what is not. And like the tax office is particularly interested in taxable income, but there are some other types of income that are not taxable that do need to go on the estimate. So like tax-free pensions, like carer payment or disability support pension, they do need to go on your income estimate because even though they're tax-free, they still count as income for some purposes and they do count as income for family tax benefit. But there are some types, so carer allowance is an example of a payment that is not taxable and does not need to be included on your income estimate or on your tax return. Family tax benefit itself is not income, and you don't include that amount anywhere on your income estimate. Childcare subsidy is not income and doesn't get included anywhere. Rent assistance doesn't get included anywhere. Energy supplement doesn't get included. So there's a few different types there that don't get included on your income estimate at all. So, which is nice for people who are getting those amounts, that, you're going to receive that amount from Centrelink, but it doesn't count as income and doesn't reduce any of your other entitlements.
That's really interesting, Rebecca. What about people who don't lodge a tax return, maybe because they don't work or they're on a Centrelink payment?
Yes, so I always get this question. So, well, you're saying I have to predict what my tax return says, but I don't even lodge a tax return. What about me? And there are some people who don't need to lodge a tax return because they are not working or their income is quite low. For childcare subsidy and family tax benefit purposes, even if you're not lodging a tax return, you still need to confirm your income to Centrelink each year. That is a requirement of receiving those payments. And if you don't confirm your income, you are, you breach of those requirements or whatever, and they will punish you, or they will send a debt if you don't confirm your income. So how do you do it? There is a confirmation of income task that Centrelink sends out for the people who aren't going to lodge a tax return. It's just a form where you tell Centrelink, I'm not lodging a tax return. This is what my income was. Even though I'm not telling the tax office what my income is, I'll tell you. And they need that form completed so that they can finalise and reconcile your benefits for the year. So for people who aren't going to lodge a tax return, you still need to do the income estimate, and you will reconcile it by doing that task at the end of the year with Centrelink. It's also probably a good time to mention that if you have not already told the ATO, the tax office, that you won't be lodging tax returns in the future, it's good to go onto your ATO account and tell them. So for some people, for instance, you might be on a disability pension and you know that you're not capable of working and you're not going to be earning an income in the future. So you can go to the tax office and say, I don't need to lodge a tax return this year. You check for any previous years that they might be waiting for you to tell them about. You can sign those off as, I didn't have any income to report, or I didn't need to lodge a tax return. And there's a box that you can tick that says, I won't need to lodge any more tax returns in the future. And doing that tells the tax office, you don't need to worry about my income in the future. I won't be lodging tax returns. You don't need to worry about me. And that's all you need to do for the tax office. But for Centrelink, they still need to know your income each year. So make sure you do that task when it comes out. It's usually the first week of July. It'll pop up in your Centrelink account and you can confirm your income then.
Thank you. That's great, Rebecca. Now, for people on only Centrelink payment, doesn't Centrelink already know what their income is going to be?
That's a good question, and we get that question a lot. So, Centrelink is paying me the money, don't they? They know what they're paying me, so why do I have to do an income estimate? They already know. And yet, look, they do. They know what they're paying you, but it's actually two separate parts of Centrelink that don't talk to each other very well. So there's the one part which is like the pensions department that pays you your disability pension or your parenting payment. And the other part is the family allowance or family assistance office, and they don't actually talk to each other that well. So you're getting your information from one department and telling it to the other department. And also Centrelink doesn't know if you are on a carer payment now, you're on a pension, but you know that in 3 months' time you're going to be starting a job and you're going to have an earned income. Maybe you have an investment property that you're going to sell this financial year, and so you're going to have a capital gain on your tax return. Centrelink doesn't know that. You know that. So you need to tell Centrelink what your income's going to be. The other thing here is that there's actually a protection built into the system for people who are on income support payments from Centrelink. And that is that when you are receiving an income support payment from Centrelink, you or your partner, if you get some of your pension or job seeker or parenting payment in any fortnight, in a particular fortnight in the year, you are eligible automatically for the maximum rate of family tax benefit Part A for that fortnight. So if you get a payment from Centrelink of your pension or parenting payment every fortnight for the whole financial year, then they actually aren't looking at your income estimate. They're just paying you the maximum rate of family tax benefit Part A all year, less any deduction for child support, which is a different way that can reduce your family tax benefit. But the Part A is paid at maximum rate without looking at your income estimate if you're on an income support payment. If you're single, then Part B is also paid at maximum rate all year, and you're eligible for that regardless of what your income estimate is. If you're partnered, then the Part B amount is paid based on the income estimate, and they look at the income estimate of you and your partner, and whichever one is the lower amount, that's the amount they use to pay family tax benefit Part B. So for people who are on Centrelink payments, if you're coupled, the only one that you're going to really worry about is the Part B amount. And for singles, you don't really need to worry at all about what your income estimate is, because you're already eligible for the max rate. You are not going to get a reduction based on your income estimate unless you earn enough in the fortnight to be over the income limit and get nothing for your income support payment. So for example, if there's a single parent on parenting payment and they have a job, if they earn under the limit, like they might earn $2,000 or $2,500 for the fortnight, they'll get some of their parenting payment and they're eligible for the max rate of family tax benefit Part A. So there's no worries about debt for those fortnights. Maybe they do some overtime one fortnight and their income goes up to $3,000 for that fortnight. So in that fortnight, they won't get any parenting payment, and that is the moment at which Centrelink will look at the estimate and say, oh, what have they put for their income estimate this year? Oh, it's $80,000 or it's $95,000. Now we will look at that amount and reduce your family tax benefit. If you don't earn over the limit in the fortnight, they won't even look at your income estimate. So you don't need to stress too much for those people in those groups. You don't need to stress too much about the amount you put on your estimate.
Fantastic, Rebecca. I wonder, can you give a suggested amount for people who are just on Centrelink with no other income?
Yes, I'll give some suggested amounts because I know there's people who just really struggle with math. This is just too hard and they really worry that they're going to put the wrong amount. So I've done some maths, some working out. Here are some suggested amounts. So the first amounts I'm going to talk about are for singles, people who are single. If you are single and you're on disability pension or carer payment or age pension, you can put $31,000 for your income estimate. Now, you need to put it in the taxable income section if it's age pension or if it's carer payment and the person you care for is over 67. But if you are on disability pension and you're under 67, or you're on carer payment and you and the person you care for are both under 67, then that amount, that $31,000, will get slotted into the tax-free pension section on the estimate. So that's for singles who are on one of those pensions. For singles who are on parenting payment, you can put $29,000 and that's taxable income. For singles who are on job seeker payment, you can put $29,000 in taxable income. And I put that amount because there are different rates of job seeker payment. Some people won't get that amount. Most people will get a rate lower than that. But I just put $29,000 because that's going to cover some of the people who are on the highest rate of job seeker payment. So that's for the singles. For couples, and this is only for people where you are both on the maximum rate of your payment. So if one of you is working and earning income or has investment income, don't use these amounts. You'll need to work it out for yourself. But for people who are only on pensions at the maximum rate or payments, if you're both on a pension or whoever's on a pension, you can put $25,000 for the person on a pension. And if there's a person on job seeker or parenting payment, they can put $20,000. And again, it sort of follows the same taxable or tax-free rules as before. So job seeker and parenting payment are both taxable income. A pension is taxable if you're over 67 or you're caring for someone over 67. It's tax-free if you're under 67 on disability or you're under 67 and the person you're caring for is under 67.
Thank you so much for doing that maths for our listeners. That's fantastic. I wonder, do you have any tips and tricks for when we do the estimate?
Yeah, so the first tip is when you go into your account and you'll go into the task to do your income estimate, it comes up with a drop box, a drop down menu to select the year that you're giving the estimate for. So you're doing this in April, it's going to have the drop down menu is going to have the current financial year, which is 25-26, and then you drop down to change the selection to next financial year, 26-27. If you put the amounts in for this financial year, the current year, this is Centrelink thinking that, they're updating their income estimate for the current year and we need to adjust their payments. And we see this too often. People go in and they're like, I've got to do it, I've got the task. And they go in and they put the numbers in for the current year and it mucks up their payments. Centrelink will adjust their payments and sometimes even reduces them quite low or even stops them depending on what numbers you put in. And that's really stressful. So don't do that. Look carefully and make sure you select the next financial year, 26-27, before you put in any numbers. That's the first tip. You don't need to do it straight away. You've got until mid-June to do it. So if you don't know what your numbers are yet, don't worry about it. Take your time. You can wait. You can wait a bit and think about it later. Especially if you've just started a new job and you don't really know what your income's going to be. Just take your time. It doesn't have to be done straight away.
Fantastic. Rebecca, can I ask, when does the estimate have to be finished by, and what happens if someone forgets or misses this deadline?
Yeah, so Centrelink wants you to have your estimate in by mid-June. It's usually around 15th or 16th of June that they want it in, because that's when they want it done in time for them to start paying the next year's rate. In July, they're going to start paying the new rate of family tax benefit or childcare subsidy. So they want it in by then. If you forget or if you miss the deadline, what happens is in June, Centrelink sends out a letter with their own computer-generated estimate of your income. And how they do that is they look at what your income estimate is for this year and they adjust it by an indexation amount, basically. They looks like wages are going up 3% or 5%. So they'll just apply that rate increase to the amounts you've already got. And the computer will spit that out and say, this is what we have put for your estimate. Please look at this. If you don't do an estimate yourself, these are the amounts that are going to go in the system as your estimate. It's important to remember that Centrelink they're not using a brain to think about that. They don't know your situation. They're just literally using the numbers that you're already in the system and adjusting them by a percentage. They're not looking at your situation at all. They don't know if you are changing jobs, if you are getting a promotion, if you are going to stop working. And it's your responsibility to get to look at those numbers and to, if they don't look right, to put in an estimate yourself. Now, you can update your income estimate at any time during the year. If you do forget, you can do it later, but you may be getting the wrong payments for a while until that happens. And for most people, for most situations, it doesn't really matter. They'll just adjust the payments and you go on. But if you leave it a long time, if you do leave it very late, you could have gotten yourself into hot water. You could have been paid too much by Centrelink, and it could be too late in the year to prevent a debt.
Thank you so much, Rebecca. What if someone's income did unexpectedly change during the year? I imagine sometimes people would sadly lose their job, or they could get a promotion, or even decide to sell an investment property.
Yeah, look, sometimes these things do happen and, you go in, you make your income estimate with the best of intentions. I think this is what's going to happen this year. And sometimes things change. You can update your income estimate at any time. So if you do get a promotion and that you weren't expecting, like, that's great, my income's gone up, and you think about, okay, I'm going to be getting an extra 10,000, 20,000 this year, and you put that into your income estimate as soon as you know. If you lose your job, again, you can update your income estimate. I would think about like hopefully you're going to get another job soon. So, you wouldn't want to drop it too low, but you can certainly update your income estimate. And look, selling an investment property, that is a tricky one because that could mean a huge change in your income. Sometimes people sell investment properties and the gain that they're reporting on their tax return could be hundreds of thousands of dollars. It could be a massive amount. So that's the one where, you could end up with a debt in particularly childcare subsidy. If your income is going to be if you think it's going to be $300,000 and then you sell an investment property and it's like, oh, now it's $700,000, that's going to mean you're going to have to pay back all your childcare subsidy that you've been paid that year, because $700,000 is well above the maximum income for childcare subsidy. So for an investment property or where there's going to be a large gain, a large change in income, I would probably ask accountant, what's my income going to be, and try and run some numbers and think, I might need to set aside some extra money to pay back Centrelink if the income's going to be a huge amount higher. So unfortunately, for childcare subsidy, there's not a great deal of adjustment made in childcare subsidy when income changes a lot. For family tax benefit, if you start the financial year saying, we're going to earn $100,000, they're paying you that amount. And then if you come in halfway through the financial year and say, actually, it's going to be $150,000, Centrelink will go, well, that's a lot more, and they'll stop your payments. And that sort of helps to prevent a bigger debt. But with childcare subsidy, they don't adjust it so well. They don't look at what childcare subsidy has already been paid this year and reduce it down a lot more than they need to actually prevent a debt. Often what they'll do is they'll go, okay, so your income was $100,000. Now it's $150,000. We'll just reduce your childcare subsidy to what people get on $150,000. And I've seen people get a debt because the Centrelink computer system hasn't looked at how much childcare subsidy has been paid at that higher rate. They don't actually adjust it low enough to cover the difference, if that makes sense. So if there's going to be a large change in income, you may need to set extra money aside to pay back Centrelink at the end of the financial year.
That's really interesting, Rebecca, and it does sound a bit scary, getting a debt for family tax benefit or childcare subsidy. Is there actually a way to prevent a debt?
Well, it's difficult when there's unexpected things happening, like if you suddenly decide, we're going to sell this investment property this financial year. If you don't have the lead up time, if you don't make those decisions earlier. Or I've seen one family where their child got a big injury and needed some medical equipment, and they accessed their super to pay for that medical equipment. And because the super only came in June, so it was right at the end of the financial year, and they had no way to prepare for that. But the extra income right at the end of June meant that they did get a childcare subsidy debt and a family tax benefit debt, and that was quite difficult. That they sort of couldn't expect it. There are some ways. So some people, for family tax benefit, you can choose to claim less money during the year, and you get sort of more or all of your entitlement after taxes are done, after your income is already known. And that's a way to prevent a debt. So you just go, okay, well, look, just don't pay me anything. Don't pay me anything during the year. Once I know my income, I'll tell you what my income's going to be, and then what my income actually is, and then Centrelink work out, okay, your income was this, we'll pay you this much family tax benefit. And that means you just get, after the fact, you get the amount that you know you're eligible for. For childcare subsidy, you can't quite do this. You can't claim for the year that's just gone based on what your actual income is. But what you can do is you can adjust the withholding percentage of childcare subsidy. And I have seen some people who are on fairly high wages and they can't quite predict how much their wages are going to be. You can actually set your withholding to 100%. So that means that you pay the full rate of childcare during the year. And then once you've lodged your tax returns, Centrelink will do the calculation and they'll work out, you're eligible for this much or that much childcare subsidy, and they'll pay as a refund the entire year's amount of childcare subsidy to you at once. So some people do that, but depending on how much childcare you use, how many children you have, that could be a huge amount of money paying full price for childcare every week. So some families can't afford to do that. But, adjusting the withholding amount from 5%, which is the standard, to 10% or 20% makes the buffer much bigger. And like I said before, a 5% withholding allows for about $25,000 of extra income. So, a 20% buffer allows for an extra 80 to 100,000 of income. So you can adjust that withholding amount to much better prevent a debt.
That's great, Rebecca. Now, a quick question without notice. Is there any interest on this debt?
No. For family tax benefit and childcare subsidy, no. There's no interest charged. As long as you enter a payment plan, they will not charge any interest. And it's a kind of a sneaky question because I have heard of people who give not a stupidly low, but a modest income estimate of their income. Maybe they might put in what their base salary is without any overtime, and they'll get childcare subsidy or family tax benefit paid at a higher amount during the year. And then when their tax returns are done, they get a debt, they get a bill, and they just pay that off from their savings, or they pay it in installments. It's a bit cheeky. I would say when you are doing the income estimate, there is a declaration that you make at the bottom saying that this is true and correct information. So I would caution against doing that. Some people do it and get away with it, but you are declaring that, this information is true to the best of my knowledge. And if you know that you're going to be earning $300,000 and you say that it's going to be $50,000, well, that's not right, and you shouldn't be doing that. But there is no interest charged on these debts, so you don't need to stress too much about it. You just have to, pay it off when you get it. I will say though, with childcare subsidy debts, if you get a childcare subsidy bill, Centrelink will withhold 20% extra from your childcare subsidy until the debt is repaid. And if your income is, say, under $200,000 or so, an extra 20% withholding is a lot. It will make your childcare significantly higher, paying week to week your childcare fees. The 20% withholding is a significant extra amount, and it will hurt. So you don't really want to get a childcare subsidy debt, especially if you're paying childcare fees. You don't want to get a subsidy debt. It's going to make your weekly childcare fee significantly higher.
Such a great answer, Rebecca. And finally, is there a way to get the maximum possible benefit during the year?
I get questions from people saying, it's like they're hedging their bets. Like, well, I don't want to get a debt, but I do need the money week to week. So I sort of want to get the maximum I can without getting a debt. And it's those two ideas are contradictory. I mean, to get the maximum during the year, you're going to put your income estimate as low as possible. But if you do that and your income ends up higher, well, then you're going to have to pay it back. So you put yourself at risk of getting a debt. So I would say for that, don't muck up the numbers. Don't just pretend. Just put a reasonably accurate estimate. And if you're getting a lower rate of childcare subsidy or family tax benefit, well, that's the rate you're supposed to get based on that income. And you just kind of have to deal with it. So no, you shouldn't be tweaking the numbers too much. You put a reasonably accurate estimate and you get the payment you get.
That was such valuable information. Thank you so very much, Rebecca.
You're welcome.
Now, for our international listeners wishing to join our Facebook group, the code word is YELLOW. And as always, this podcast has been information only and not personal advice.